Guys, in this video, we're going to talk about two most important, crucial numbers for trading next week. And the numbers are 16 and 27. If you know the answer to what these numbers are, because, this question is a bit tricky, type in the answer below for a chance to win the winning watch list. Now, take a moment to figure out what these numbers could actually mean before I give you the answer. So I'm going to count until 5. 1, 2, 3, 4, 5. And here's the answer, guys. The first number is the number of the VIX, 16. Now, you may be thinking, what's the big deal? Okay, what's up with the 16? Why is it so crucial? Why is it so important? Why should I be paying attention to it next week? So here's the answer. This is the chart of VIX on February 6th. In a second, I'm going to show you the chart of VIX on February 8th so you can see the difference. But the most important part in this chart is, look, every time VIX has gotten to 16, what happened? It bounced. This is when we had the huge drop in the markets, right? VIX got inverse relation with the market. So VIX goes higher, markets drop. That was October. VIX goes higher right off this 16, which happens to coincide with this orange line, the 200-day moving average, right? Bounces, markets drop. Bounces again in December, continues the bounce, markets drop. Okay, got a nice head and shoulder going on right now. But look, this time, guys, look at this. It gets to 16, and what? Instead of bouncing, look at this. It actually breaks below. So what that tells us is, hold on. All the heavy bears out there that still think the markets is going to go to December lows, guys, I have some bad news. It doesn't look like it's going to happen. You're going to say, yeah, but the market dropped for the last 2 days. Leonardo, where have you been? We're worried you're turning into too much of a bull. I mean, we can handle some of your bullish videos for a little while, like a month and a half, but now this is getting out of control. So stay with me, guys, because what I'm seeing here should really help you out, okay? So what we're observing is a break of the trend. This is a trend reversal. Now, you're going to say, well, we had a trend reversal here. We had a trend reversal here. Well, this is another one of those. This is a very tough one to spot, though, because the market is not making the big moves that it used to do in October, November, December. We're looking at small, miniature moves in the markets for the duration of the last month, and I think this is likely to continue, so let's take a closer look. What this really means is there is a shift in the market environment. It actually indicates we could possibly be going to this market environment where VIX is between 10 and 14, and trust me, you do not want to be a bear when the VIX is between 10 and 14. So here's what happens on February 7th and 8th. So clearly, if you've been a bear, you were celebrating the last couple of days because you're like, oh yeah, I told them, man, the market is going to drop. Here it is, it's dropping. Well, not so fast. Here's what we've got on the VIX. You see these two candles. If you've taken our chart course, you would know that these are bearish reversal candles. You see those tails that stick it out. We call them the failed rocket launch, right? The rocket gets launched, comes back to Earth. Now, the interesting thing is, it's not just one bearish reversal candle, because if it's one, yeah, sometimes it's extremely effective, just like the two back-to-back ones, but generally the probability is going to be higher when you have two bearish reversal candles back-to-back, guys. And here's plenty of examples here. What do you see here? Do you see this? I want you to pay attention to the formation of the candle, right? The tail is sticking out to the moon. The tail is sticking out to the moon again. What happens? VIX drops further. Same thing. We got 3 bearish reversal candles right here. What happens? Huge drop. We got 2 bearish reversal candles. What happens? Drops. We got 2. 1, 2. Look, it's the formation of the candle that's important. You see that wick sticking out right here, the tail of the candle. Boom. What do we have? Drop. Look, 1, 2 right here. Drop. 1, 2, drop. 1, 2, drop. 1, 2. Guys, VIX is set up to drop, and when VIX is dropping, markets go higher. Now, if this is not enough, here's some evidence, which is coincidentally, guess what S&P 500 is doing, and actually creating 2 sets of back-to-back bullish reversal candles. Do you see these candles are exactly freaking the opposite of what the VIX is doing? Just check this out. Look, the tail in this case is sticking all the way down, and then it climbs higher towards the end of the day. So we're dropping to the lows of the day. We're not closing nowhere near the lows of the day. As you've seen S&P 500 yesterday on the Friday made a huge rebound towards the end of the day. It hit 2680 and finished at 2707, as you can see right here in this chart. Now let's work for the history of this chart. When you get these type of bearish reversal candles, what happens? Do you see this set right here? 1, 2, we go higher. 1, 2, go higher. 1, 2, separated by another small one, we're going higher. Look at these two right here. 1, 2, bearish reversal, we're going higher. 1, 2, going higher. Guys, this is pretty consistent. So what is not consistent, however, is not many times do you have exact opposite like this, right? Clearly, VIX and S&P 500, it has an inverse relationship, but not very often do we have a circumstance where you have two bearish reversal candles back to back on the VIX coinciding with two bullish reversal candles on S&P 500. And I'm not talking, I mean, I'm just trying to have you pay attention for a second about these bearish and bullish reversals that are happening. But let's take a closer look at some other things. One of the things that made us predict the market was going to go higher after December 24th, in the first video I think posted like December 27th, was the oil, right? So we said if oil stabilizes, the market is going to stabilize. They're going to go sideways to higher, not just for one day, but for multiple days, like 10 days plus. Look at what's happening. So finally now we're getting some negative coverage on oil again. They're saying, oh, the oil is going to drop. Oil is going to drop. Guys, surprise, surprise. What do you have here? How do these candles look to you? As everybody's talking that oil is going to go lower, you got bullish reversal candle, bullish reversal candle. Let's talk about the bullish reversal candle one more time in the history of oil. Bullish reversal, same pretty much candles as we're seeing right now. What happens? Goes slightly higher. Bullish reversal candle, bullish reversal candle goes higher. Bullish reversal goes higher. How about this? This is what I'm really interested in. Guys, September. Look at this. This actually coincides, this bullish reversal candle in oil coincides with this MACD indication where it looks like MACD is actually making a bearish crossover, which is why I highlighted this right here for you. So look, it looks like we're making a bearish crossover, like things are completely about to unwind and drop. But it coincides with the two bullish reversal candles. So that tells me we're actually not going to have the crossover. Oil is going to bounce off of here. Now, I'm not saying that Monday when the market's open, oil is not going to like maybe drop $1 and then start going higher after that, multiple days higher. So there's still a possibility of a small drop before oil bounces higher. But maybe it'll just make a small bounce, or maybe just start bouncing right on Monday right here, because we're observing exactly the same thing, right? So two bullish reversal candles coinciding with the same market condition on the MACD creates the next day still in the red. But look after that, takes off, drops, sideways, takes off big time. Observing these consistency in the bullish reversal candles create pretty solid case. Besides some of the other things that I just don't have time to cover in this video, there's a ton of other bullish things that are in the making. But getting back to the main subject of the video, the most important numbers to be paying attention to, it is actually on February 8th, towards the close of the day, I took a snapshot of this, which was S&P 500 futures, and they've been struggling literally for the last 2 days to maintain this level of support of 2,700. Now, 2,700, if you look at the chart, doesn't look like it's a huge support because really the orange line is like at about 2,740. But this has been a huge psychological level of support where the stocks in the past months throughout the history of 2018 where they've dipped below this level and they went substantially lower, but those times when they did hold the levels, we actually turned higher from there. And in the last couple of days, we've been observing some substantial accumulation from some of the major players, major financial institutions have been buying this dip. And so this level right here, as you can see, the moment the market was struggling here for some time to cross over this 2,700. But look at this huge volume right at the very end of the day, right? All of a sudden, we're making this breakout, literally 8 points within a minute and a half. In 1 minute and 30 seconds, boom, out of this 2,700 range. Look at what's happening right here with the VIX. So as S&P 500 actually validates this support level of 2,700. It validates the support. It actually dropped below the support all the way to 2,680, bounced off of it in the second half of the day in the move 4 type formation based on how markets move formula. Then the same thing as it's doing that, very important that VIX is breaching that super important level that I was showing you earlier, how it bounced each and every time off of that level in October, November, December, but this time it is actually breaching this level. At the same time, S&P 500 is climbing above this 2,700. So here's the point. As long as VIX stays under 16, we're in a totally new market environment, and we should not be comparing things that we've seen in October, November, December to the current market environment. The fact that the 2,700 stayed very nicely and was guarded so much by the financial institutions telling us that they're looking to buy stocks because the selling was done on very small volume. So keep this in mind. Again, VIX under 16 tells you remain a bull. S&P over 2,700 tells you the same thing. So very important, but I thought it was so cool how it was happening simultaneously at the same time. It was a critical level that S&P 500 actually held and did not break below and finished strongly higher above that level. And at the same time, VIX was breaching its key level of 16, and it did break below and finished at 1572. Guys, awesome stuff. Like stuff like that, if you're paying attention to charts and you know what to look for, this is just phenomenal because it doesn't happen very often, right? So this is really cool. Basically, in my view, I was able to picture here capture the eternal struggle of bulls and bears in the chart of VIX versus S&P 500 future. Okay, guys, this takes me to the next very important point. If you analyze all the huge drops in the market, they happen when the market participants do not expect the news that actually hits the market. So if you remember like last year, when all of a sudden February 9th was the day where the market was dropping like 1,200 points in one day and it finished higher, similar to the reversal we observed just yesterday on February 8th, with much, much more drama. Well, it was happening because the high expectations for high interest rates, and it was unexpected. And that's why the market tanked. And then we had these news on tariffs, which at the time were not expected. And so now when you're seeing the market drop, a few hundred points on Thursday and drop slightly on Friday and rebounding off these levels, typically the market would have tanked 1,000 points because you have all these negative headlines all over the place, right? There's no trade deal with China. There's there's nothing positive there again. And yet the markets hold themselves up and finish in a positive territory on a Friday. Guys, this is very, very important to observe because that tells you that the market does not care about the trade deal. It cares about it in a way, but because it's not fresh piece of information, it doesn't have such a strong validity or the element of surprise as it had when the story was fresh a year ago. So a year ago, literally the markets were going down 800,000 points on this tariffs deal. Now everybody's used to the story. Something new completely needs to happen in order for the markets to drop substantially from here. And what we're observing is when markets did drop in the last couple of days, they did not do it on huge volume. So the two definitions that I have actually created for myself over the last 14 years is the markets, they don't crash, they don't do crazy, sharp moves to the downside unless these two things two conditions are met. Again, one of them was the news have to be some kind of news that the market does not expect. And in this case, the trade deal with China, it's old news. Whether it happens or not, nobody really cares about it to as much of an extent. A lot of the element of surprise is taken out here. And the markets are not currently falling on huge volume. So none of these definitions are met. Therefore, it makes more sense to be a bull rather than a bear. So guys, please do not short this market in expectation of a sharp drop or revisit of December lows, because it's not going to happen. Not now, not in the near term. Near term for me is like next 30 days. Convert into a temporary bull for best results. Now, here's a quick note with that. This does not mean like do not short anything out there, period. What this simply means is do not short stock based on direction of the market. If you have a solid case for a specific stock that has a catalyst to drop just pertaining to that particular stock, then clearly it makes sense. But do not short, let's say, Amazon just because you think the market is going lower from here. I hope you guys can see the difference. Now, some of the market moves have been taking place. Move 3, 1, 7, 5, ended up into a 3 and finished with a 4. Basically, in the sequence we're watching for next week, there's a high probability of a move 1, 7, in which case they're both green bullish moves. What does this mean for the markets is the ultimate question, right? So here's where we are. This is what I've been talking about, October, November, December. Now we are in February. Markets are looking like what everybody was thinking what they were going to do, right? Oh, once we don't hold this level, we're going to go back all the way to 26.15. And once we get there, we're going to drop all the way back right here, 24.50, 23.50. Guys, we just discussed why that's not going to take place. And the most crucial element, I think, to observe on this chart is everybody's saying, okay, we're not going to break above this orange line. And I know a lot of people were celebrating observing these couple of days lower. The most important part of this chart is the fact that each time we have gotten to the orange line, that we might not have breaking above it the very instant we got close to it. But look at this. Each time we got above that. So the next level really to me is not this 2740 level that everybody's talking about. The next level is more like closer to this 2800. So meaning S&P 500 closer to 2770, 2780, which we are healthy 70, 80 points away from that. So that gives a pretty good substantial amount of energy for the stocks to climb higher. And again, I would be targeting the level to slow down and be in a bull when we get to this level of 2780. That could take us a while because, you know, if we examine some of the history, there is some days where we're just going to be going sideways. And so with sideways trends, don't expect this move higher of 70, 80 points to happen in the next week. I mean, I think we're going to easily try to retest this 2740 and maybe going sideways. And I'll show you in a second a very important chart, which I've actually shared in the previous video, that I think could be very useful. So don't compare October, November, December to February because the VIX environment is totally different now. It's different. The VIX in relation to this chart is different. What's different about it? You may say it's still about 16 if you look at the VIX chart. Well, what's different is in October, November, December, VIX was uptrending. And right now, VIX has been downtrending for 2 months in a row. So that's the difference in the VIX. Okay, so where are we going? Okay, so if everybody's thinking that we're going here, I put a big red cross in. No, we're not going to revisit this 2366 anytime soon. Instead, what we're most likely to see is the market environment, as you can see right here, which is totally different from the market environment we've seen right here. Basically, the markets are not making any huge moves. You see how they're going up, down, up, down, up, down. Basically, sideways trend. Overall, they're grinding higher. They are, but not without some of the drops on some of those weeks. Clearly, I mean, there's some red candles here, right? But the moves are smaller, and the overall move is higher, not lower. Do you remember the charts of 1975 indexes in the prior video? This is what we've discussed, making the bullish case all until July. What we're seeing here, guys, do you see anything familiar out of what we've discussed in this video? I highlighted this for you. Actually, this is not even a tricky question. Look at these two candles. No, dude, this can't be real. Are these the bullish reversal candles? And we're talking about 1975. Oh my God, no. So, I mean, I understand the VIX, the oil, you know, the current S&P, but 1975 had the same thing? Wow, this is insane. So, and look what happens next. This is the same condition. In 1975, the market hits this orange line, 2 days lower time frame, but the idea is the same. It bounces a little bit lower, 2 bullish reversal candles. What happens next? Markets goes higher, ultimately breaks above the orange line, kind of moving sideways from there. Very, very close to the market conditions right now, because if you look at the MACD on the S&P chart right now, it's actually doing this. So very, very similar conditions. Despite of the small pullback from 2737 to 2680, S&P accumulation looks really healthy. So this is S&P 500 drop in the last couple of days. This is the accumulation. It's actually quite strong. It moved from here all the way to here. They're buying it. We actually have a nice divergence. Look, so when on Thursday, markets fell to a level of 26.85. Accumulation was here. When the markets fell lower on Friday to 26.80, accumulation was substantially higher than here. That gives us a bullish case of divergence. And look what happens by the end of the day, right? Boom. So we actually were able to identify perfectly this is a market move 4, which gives you a really good opportunity. We send out the alert to buy some calls when the markets were trading 26.82, which was about 10:30 in the morning. So this was, you know, guys, if you don't know all the market moves and you're trying to be better as a trader, click the link below, get the course studied, start applying it every day. It's going to make your life as a trader much, much easier. So basically what that indicates, big banks continue to buy the dips even at these high levels above 2680 and 2700. Now, why do I say high levels? High levels in relation to the low levels that we've had. So we've had a substantial move from 2300, close to 2300 in S&P. Now we're at 2700, and they're still buying. They're buying pretty much every dip. And in a diminishing VIX environment, we typically are not seeing multiple consecutive days lower as we were observing in October, November, December, where the markets literally were going, what, 7 days lower in a row. So right now you can have a situation where the market could go lower 1-2 days, but it's going to be very, very challenging to see markets drop like 3 days in a row. So generally we'll see maybe a move lower, move higher, move lower, move higher, which is basically how most of these sideways trends are created. Okay, you may be wondering, what are the simple, basic, practical applications from all the information that we've discussed so far? So number one, sideways trend kills options values, period. So the longer time you get, the safer your position is going to be. So get more time on expiration for higher probability. So maybe instead of buying this week expiration, buy the next week expiration. So maybe instead of trading options that expire in 7 days, buy the ones that expire in 14 days to give yourself a little bit more time. Why? Again, because in the sideways market trend, you're not going to have these huge moves as you've had in a different environment described in the prior few months. And you want to allow stocks a little bit more time to climb higher. Therefore, buying a little more time makes sense in this type of market environment. Point 3, limit day trading. Because the daily moves, guys, they're just not as huge. I mean, they're still going to be huge in some individual stocks that maybe get an FDA approvals or something like that. But, you know, overall, if we're just taking a simple stock on a regular day, it's going to basically trend with what the market is doing. So it's not going to be able to make any huge moves because the market is not moving crazily like it used to. Therefore, day trading conditions are not the best right now. It's best to focus on swing trading and allow your position, you know, ideally 2 to 4 weeks, you know, remain in this bullish positions and give the stocks enough time to appreciate in price. Okay, here's the example. Example is this Google. Is there anything you guys see on this chart? Please be honest. If your answer is, I don't see anything on this chart, Leonardo, you need to click the link below and take the charts course right now. You can't be trading stocks no more without looking at charts, guys, because it's tremendous help when you're trying to go for the straight. So what do you see? If you're not seeing what we're about to discuss, you really need to do that, guys, for real. Here's huge volume right here. Huge volume on Google as it goes higher. They actually broke above this very crucial level, this orange line, 1128, 1129. Stayed there in huge volume for a day. Then the market started turning around and it dropped to just under 1100. Now it's to 1102. Now, what is the most important observation? They were buying the heck out of it on the way higher. Now the stock dropped. Now look, every day it's been dropping for the last 3 days. What's been happening to the volume? Google has been dropping on substantially lower volume than the purchasing volume in the prior 3-4 days before these last 3 red days. Notice the accumulation distribution. Does it look like they're selling it? Don't look like they're selling. The accumulation distribution is the highest level on this chart. You may say, Leonardo, are you blind? Can you not see this MACD indicator? It's about to cross. It's a bearish move in the MACD. It tells you the stock is going to fall further. Well, look at this. You see this right here? We had the same situation on the MACD. This is why I circled it for you. And look what happened. Even though MACD looked like it was going to cross lower, look what happened in price of Google. It went from 1,000 all the way to 1140. Now that's a $140 move. Guys, there's a lot of bullish things here. What more important than anything, if you use your imagination, if you try to picture in your mind cup with a handle, I think Google is going to break out substantially higher from here. I'm talking about like $1,200-1,300 in the next 6 months. And in the next month, it could actually easily hit 1,200 level. 1180 possibly in the next week. So what I'm thinking is going to take place is all this volume right here, they're going to come in and they're going to start buying Google next week. They're going to drive it back to 1128, and from there we should have a pretty nice reversal. And what you want to observe at this point is the volume accelerating as it gets back to this level of 1140, 1150. If the volume is accelerating, we can have a substantial break to this level right here, which is going to be the next stop, about $1,180 to $1,200, right around here. So cup with a handle if the volume is accelerating. Now, if you see it gets here and the volume just dies off, I mean the gray bars, the buy volume, if it's dying out right here, it's going to be a failed cup with a handle breakout, and it may retest some of these lower levels yet again before ultimately moving higher. So be careful, when it gets to 1140, 1150, pay very close attention to what the volume is doing to make the best trading decision. So Google 1200 plus near term. On February 8th, Google intraday bullish divergence observed between the price and the accumulation. So here's what's happening with Google. It drops on Friday from 1106 all the way to 1095. Look what happens to the accumulation. They're buying it. They're buying the dip. This is how institutional banks buy the dips. Now, same behavior in Amazon. Observed banks continue to accumulate shares above 1580. Guys, if you talk to any institutional investor, please, they don't pay no attention to no National Enquirer, okay? They think it's a deal of a lifetime right now. I'm talking about Amazon shares, and they are buying it. Now, tell me, please, one thing that you see on this chart that we discussed today, pretty much throughout the whole video here. Guys, look at this. These are bullish reversal candles. I know it looks like the stock is falling, and it just dropped under this blue line. So had a lot of subscribers like, dude, oh man, it broke below this blue line. Man, it's going lower. And guys, sometimes stocks are going to break below certain levels. But what's important to understand, they're not going to stay there very long. And I think observing these two bullish reversal candles with this high accumulation, okay, this tells me they're buying the stock as it's dropping. So in other words, I think institutional investors are buying and accumulating the shares of Amazon using these, what appears to be negative National Enquirer headlines all over the news, right? So they're buying this news, they're buying the dip. Ultimately, I think we can see Amazon back to 1650, 1700 here in no time, maybe in the next few weeks. So big banks are buying this crazy news. Ultimately, such behavior resolves in a move higher, so be patient. Be patient. Remember, we've talked in these market environment, it pays to buy calls in the money, and be patient and wait. Buy yourself a little extra time. Okay, and a little bonus at the end of the video for those of you that are still here. Check this out, Bitcoin. Now, in December 2017, I said Bitcoin, when it was at 18,000, I said it's going to drop to 3,000. And I had a lot of haters because I said so. Well, charts don't lie, and I stick to my rule all the way when it was falling from 18,000 all the way to 3 grand. Now, I am saying this is the time to buy Bitcoin now. We got a nice pop, finally, and I'm not saying Bitcoin is going back to 18,000. But I am saying that it could easily revisit the levels of 5,000, 6,000 from here. So for those of you that are Bitcoin lovers out there, congratulations. Time to load up, time to buy. Look at these nice, healthy accumulations throughout Friday trading. Now, we have used Bitcoin in the past to actually successfully predict the next market move, just as one element of predicting where the market could be headed next, because generally Bitcoin moves ahead of, in a direction just ahead of the markets. So in this case, I think this initial move in Bitcoin is going to be sustainable. It will move higher, not necessarily consecutively higher each day. Just expect there's going to be some pullbacks, but overall, I think people are going to start coming in and start buying it. The wild trade for Bitcoin lovers, okay? Do you remember, guys, GBTC in December 2017, look, $2,201. Actually, this is not the best chart. It hit like 2,800 at one point. So GBTC, December 2017. Where do you think GBTC is today? And for those of you that may not have traded GBTC back then, it's Bitcoin Investment Trust. Unfortunately for us, it doesn't trade options. Fortunately, for those of you that are Bitcoin lovers, here on February 8th, 2019, you can buy it for $4.46. I'll be like, whoa, hold on, Leonardo. Did you say it was just 2,200 on the chart before a year ago? Now it's at $4. Yes, but it is a bit tricky because GBTC did a stock split. 2000 valuation came down to like, when they did the stock split, it ended up being like $20. So it literally dropped from 20 to $3.80. And if Bitcoin goes back to 5-6K, it's reasonable to assume GBTC is going to double. So maybe from $4 back to this 8 range, 9 range level. A very strong volume, as you can see. MACD is extremely bullish. RSI finally picking up. So, and look at this accumulation. Finally buying. We're finally getting some buyers. So if we get a follow for a day on a Monday, guys, I think Bitcoin it's not going to the moon, but it's moving higher. So congratulations to those of you that, I shouldn't say congratulations to those that were not listening to me in December, because if you sold Bitcoin at 18 and you shorted it, you would have been able to buy substantially more Bitcoin at this price right now. So have fun, guys. Happy trading next week. Don't miss the next video. And in the next video, guys, check this out. I will reveal one thing that could go to the moon in the next 5 days. And it's not Bitcoin. If you have any questions about trading stocks, options, click the link below. Schedule your 20-minute, 30-minute consultation. Get all your questions answered. Guys, take the chart course, 30 market moves course. Let's roll. Let's make a bunch of money. Happy trading this year. Talk to you guys in the next video.